It's natural gas, not oil, that will break much of the world's back, particularly in Asia, but not ours. There's a huge reason why our markets can shrug off the Strait of Hormuz, even as most nat gas-hungry countries can, because they get a lot of their gas from Qatar, formerly the world's biggest exporter before being taken offline by a devastating Iranian drone and missile attack. Second, number two, let's talk about inflation more broadly. The consumer price index we got Friday was already elevated by tariffs. They were the principal reason for higher prices of late. Now we tackle on the price of the pump, and it's going to get worse. However, the Fed will most likely asterisk these as all one-off price increases. They won't take it under consideration when they mull whether to cut rates. Instead, new Fed Chief Warsh will be thinking of housing and how to get it moving. I don't know if he can convince the rest of the committee to cut rates, but it's a real possibility, and that's allowed the averages to stay buoyant. I think I've been negligent to you in bringing up the power of low rates because it's the reason the bulls keep winning when it seems like they should be slaughtered. Let's not overthink it. If interest rates were spiking, this market would be very different. We'd be down very hard. Instead of being overbought to the tune of 7 on the S&P oscillator that I follow, by the way, that is a little too high for my taste. I would be taking something off the table here. We are going to address that exact concept of taking something off the table Thursday noon at the club meeting. Still time for you to join. Now, it's not that you can just take away the war as an input, but we have to ask ourselves, what stocks are truly impacted by the war? Stocks are typically valued as P, price, equals E, earnings, times M, the price to earnings multiple. I call this process of seeing where a stock will go, solving for M. If you can gauge M, you can figure out where a stock might be going. When you solve for M, the multiple, you're trying to take in all the things that influence what we're willing to pay for a company's earnings. There's like 20 pages in this in the book. When I try to figure out how the price of oil figures into the M for most stocks, it comes up snake eyes, no bueno. There just isn't that much impact. Or as I used to say on the trading desk at Cramer Company, what's the Strait of Hormuz got to do with the price-to-earnings ratio of Bristol-Myers? Yes, that's where it's from. And the answer is nothing.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.